Do you want to make profits from mortgages like banks? You can do the same thing, making money effortlessly with private mortgage lending, offering short-term loans backed by real estate, which provides you with a passive income that is secure, steady, and earns a high return, typically ranging from 10 to 18% annually. In this video, I'll break down the benefits of investing in private mortgage lending and how you can get started and mitigate your risk. First of all, private mortgage lending is not loan sharking. Like the banks, private lenders are regulated by the Financial Services Regulatory Authority of Ontario, FSRA, and operate within a legal framework, adhering to regulations governing interest rates, fees, and lending practices. So why anyone would want to borrow money at the interest rates much higher than the banks? People choose to borrow from private mortgage for a variety of reasons. Here are some of the main reasons. One of the most common reasons is bridge financing. Private lenders can provide short-term loans to bridge the gap between selling one property and buying another, or to fund renovations before securing a traditional mortgage. Another reason is for self-employed individuals, or those with non-traditional income sources. They may struggle to provide the income verification required by banks. Private lenders are more flexible in assessing different forms of income. A major advantage of borrowing from private lenders is faster approvals. Private lenders often have streamlined processes and can approve loans as fast as 5 days, which can be crucial in situations where time is of the essence. A common use of private mortgage loans is to consolidate debts. Private loans can be used to consolidate high-interest debts, such as credit card debts and car loans, into a single loan with a potentially lower interest rate. Finally, individuals with poor credit history, such as past bankruptcies or other credit challenges, may find it difficult to meet the stringent requirements of traditional lenders. Private lenders are often more lenient in this regard, focusing more on the property's value and the borrower's ability to repay. So, what are the advantages for you as the lender? Number 1. This is a very passive form of investing. Other than doing your due diligence before releasing the fund, there's really nothing else to do afterwards. Unlike being a landlord, you would have to constantly look after the troublesome maintenance and tenant issues. Number 2 is consistent returns. Private lending delivers very consistent returns. If you loan out your money at an annual interest rate of 12%, you can confidently make 12% on your money 1 year later. Unlike investing in the stock market, your returns will fluctuate greatly. Number 3 is security. Your money is secured against a piece of real estate. In case the borrower defaults, the lender can sell the property to recover the loan. Number 4. No extra fees. The borrower pays all the fees incurred during the transaction, including both the borrower's lawyer and the lender's lawyer, broker fees, appraisal fees, insurances, and so on. There are several key factors to consider when deciding whether to accept a private mortgage loan application. These factors help them assess the risk associated with the loan and the ability of repayment. First is mortgage position, which refers to the order of priority on the collateral. The first mortgage has the highest priority for compensation, meaning it will be repaid first in the event of a power of sale. Subsequent mortgages will only receive payment after the first mortgage is fully repaid. Therefore, the first mortgage carries lower risk but also has lower interest rates, typically between 8% and 10%. The second mortgage carries higher risk but also higher interest rates, usually between 10% and 14%. Number 2 is loan-to-value, LTV, ratio. The LTV ratio represents the loan amount as a percentage of the property's appraised value. It's the most critical metric used by lenders to assess the risk associated with a mortgage loan. I will explain what is LTV in detail on the next slide. Third factor is property value. Lenders will conduct an appraisal to determine its market value and assess its location, condition, and potential for resale. A property in a desirable location with good resale value is more attractive to lenders. Fourth factor is borrower's creditworthiness. Private lenders may be more lenient than traditional banks regarding credit scores. Instead, they look for any red flags like bankruptcies, collections, or a pattern of late payments. 5. The borrower's income and employment. Lenders need to assess the borrower's ability to repay the loan. They will verify income through pay stubs, tax returns, or bank statements. 6. Purpose of the loan. The reason for the loan can impact the lender's decision. Private lenders may be more willing to finance properties for investment purposes or to provide bridge financing for short-term needs. Finally, exit strategy. Lenders want to ensure that the borrower has a plan to repay the loan. This could be through refinancing with a traditional lender or selling the property. How to calculate LTV. LTV is defined as total mortgage amount, divided by the appraised property value. For example, if a person buys a house for $1 million, and he takes out a mortgage of $400,000, the LTV of this house would be 40%. That is $400,000 divided by $1 million. In case this person wants to take out a second mortgage, how much can a lender lend him? Private lenders generally prefer LTVs less than 75% to minimize their risk. In this case, the second mortgage would be up to $350,000. $400,000 plus $350,000 divided by $1 million is 75%. A lower LTV means a lower risk loan, because if property values decline, a lower LTV provides a cushion, reducing the chance that the fund received in a power of sale is less than the loan amount plus expenses. The following case studies will provide a clearer understanding of our application evaluation process and the potential returns for each scenario. This is an 1,100 square foot office condo in Markham, a prime commercial location. The appraised value is $500,000. The borrower is seeking a $200,000 first mortgage loan for 1 year, open term. The loan-to-value, LTV, ratio is a low 40%, indicating a relatively safe loan. The borrower is a realtor with credit score of 620, a bit low, but he has no history of bankruptcy or missed payments. Loan terms include a 10% interest rate for 1 year, open, lender's fee is 1%. The total return for this $200,000 loan was $22,000. This is an island resort on Lake Simcoe, valued at $9 million. It has an existing mortgage of $2.8 million. The borrower is seeking a second mortgage of $1.3 million for 1 year, open term, to upgrade the septic system. The loan-to-value ratio is a low 46%, making this a low-risk loan. A group of 3 lenders funded the loan. I am party A. My share was $1 million. I earned a 1.75% lender's fee, equal to $17,500, and 14% interest. That amounts to $140,000. The gross return was $157,500. To finance my portion, I refinanced my own property at a 5.5% interest rate, incurring a cost of $55,000. This resulted in a net profit of $102,500 for me, all without using any of my personal funds. This scenario demonstrates a strategy known as interest rate arbitrage, where the investor profits from the difference between interest rates. This is for a second mortgage on a newly built detached house in Kitchener, valued at $1,360,000. There's an existing first mortgage of $800,000, and the borrower is requesting a second mortgage of $180,000 for 1 year, open term, to consolidate debts. The borrower is a self-employed truck driver with a low credit score of 551, but he has no history of bankruptcy or missed payments. The LTV is 72%, high but within the acceptable limit of 75%. The application was referred to an investor. She earned a 2% lender's fee of $3,600, and 12% interest for $21,600. The gross return was $25,200. The investor financed the loan using a line of credit at 7.15% interest, costing $12,870. Net return for the investor is $12,330, achieved without using any personal funds. This scenario involves a second mortgage application for a detached house in Newmarket, valued at $900,000. The property already has a first mortgage of $350,000 and a second mortgage of $200,000. The borrower is seeking a loan of $300,000 to pay off the existing second mortgage. The requested term is 1 year, open. The borrower is a self-employed car mechanic. His income is unstable and his credit score is very low at 492. The LTV ratio for this loan is 72%, within the maximum allowable limit of 75%. While the borrowers offer to pay a 2% lender's fee and 12% interest, I still declined to provide the loan. The borrower's attempt to pay off existing debt with additional borrowing raised my concern about his ability to repay the loan. Furthermore, the house is old and remote, making it hard to sell in case of a power of sale. The process of setting up a private loan is relatively straightforward. The borrower initiates the process by determining how much money he needs and submits his property and credit information to a mortgage broker. The borrower's broker prepares an application form and distributes it to brokerages that represent lenders. The suitable lender lays out the loan conditions, including the amount, the interest rate, the terms, and any associated fees, and passes on to his lawyer to draft a loan commitment letter. The lender's lawyer sends the letter to the borrower's lawyer for the borrower's signature. Once the borrower signs the commitment letter, the lender advances the funds to the lender's lawyer's trust fund. After the lender's lawyer ensures that the borrower has fulfilled all the conditions, then he registers the mortgage on the property title in Ontario Land Registry and releases funds to the borrower's lawyer. The borrower's lawyer oversees the closing process, ensuring that all legal requirements are met, funds are properly disbursed, and the mortgage is registered with the appropriate authorities. In actual practice, private lending involves extensive paperwork, but lawyers handle every detail, ensuring a safe and smooth process, and look after the interest for both the lender and the borrower. One of the most crucial steps in the lending process is registering a charge on the land parcel with the Ontario Land Registry. This registration indicates a financial claim against the property, detailing how much money is owed and to whom. The owner wouldn't be able to sell or refinance the property if the debt isn't repaid. In case a borrower fails to uphold the terms of the mortgage, power of sale is usually used in Ontario to recover the lender's principal, interest, and expenses. The lender must follow a strict process in order to follow through with the eviction of the occupant and the eventual sale of the property. The power of sale process begins when the borrower has failed to make one or more mortgage payments. The lender must wait at least 15 days after the default to deliver a notice of sale under mortgage by registered mail. Then, the lender must wait 35 days before taking any further steps. The waiting period after the notice of sale is delivered is referred to as the redemption period. During this time, the borrower must bring the mortgage into good standing. If the borrower does not pay, the lender is able to issue a statement of claim for the collection of the debt and for possession of the property. After the statement of claim is issued and served, if the borrower does not file a statement of defense, the lender can sign a default judgment. The lender brings a court motion to ask the court for leave to allow for the issuance of a writ of possession. Once the writ of possession is issued by the court office, the lender delivers it to the sheriff and the sheriff schedules a date to evict the occupants. After the occupants are evicted, the lender will proceed to hire a licensed real estate agent to list the property for sale on MLS at market value. When the sale is completed and the money is received, the proceeds of the sale are paid out in the following order. The expenses incurred in selling the property are paid first. This includes the real estate agent's fee, the real estate lawyer's fees, and other related fees and expenses. Payment of the lender's principal and interest and other sums to which the first mortgage lender is entitled are next to be paid from the proceeds of the sale. Funds left over after the previous payments is then made to subsequent mortgagees, lien claimants, and execution creditors in the priority in which they were registered. Any remaining money after all other parties have been paid must go to the borrower. In Ontario, the time needed to process a power of sale is largely dependent on the marketability of the properties. It would typically take at least 3 months if every step proceeds smoothly. Therefore, it's essential to ensure that the property being used as collateral in a loan can be easily sold in the event of a power of sale. Lenders' broker agents play a crucial role in protecting the lender's interests and optimizing the profit. First of all, they source borrowers. They connect potential borrowers seeking private financing with the lender, leveraging their network and marketing strategies. Second, review loan applications. The broker thoroughly assesses the borrower's creditworthiness, financial situation, and the property being used as collateral. Then, there is loan structuring. They recommend structure the loan terms, including interest rate, repayment schedule, and any additional fees or penalties. Another important function is documentation and compliance. The broker ensures all loan documents are properly prepared, executed, and comply with relevant legal and regulatory requirements. Finally, there is loan closing. They follow up with the loan closing process, ensuring all conditions are met and funds are disbursed to pay lender's fee, the brokers, the lawyers, and any other associated costs. Private mortgage lending offers a compelling avenue for generating passive income, attractive returns, and built-in security. By partnering with experienced professionals, you can successfully unlock its potential for profitable investments. Please write to the email address below if you are interested in investing in private mortgage lending.